This is Al Brooks, and this is my price action trading course. This module has to do with wedges. Again, most reversal patterns are trading ranges, and I'm working through the list of common reversal patterns, and the current module has to do with wedges. An ideal wedge has a wedge shape, a channel with convergent lines, and it can be sloped up for a top, it can be sloped down for a bottom. The minimum requirement is 3 pushes within a channel, and if it's sloped up or down, you call it a wedge. If it's mostly sideways, a 3-push pattern, you call it a triangle. It can be contracting, it can be expanding. Whenever you have a rising wedge, you have a potential top. You're looking for a failed breakout of the top of the wedge and then a reversal down, preferably with a strong bear reversal bar, and that would be a reasonably good signal bar. An ideal wedge bottom, you'd have a falling wedge, and you'd have a little breakout below and then a strong reversal up with a strong bull reversal bar for the buy signal bar. Here's an example of a wedge. You have 3 pushes down, you have a bear breakout below the bottom of the wedge, and then a couple of bars later you have a 1-bar final flag and then a pretty good looking bull bar closing near its high. That's a reasonable buy setup for at least 2 legs up, 10 bars, 2 legs up. Again, it has a wedge shape, a convergent shape. A lot of wedges don't really have wedge shapes, and that's not important. A lot of times it's just a simple 3-push pattern. The closer it is to the ideal, the more reliable the trade would be. Most wedges are not perfect, and any 3-push pattern qualifies. Many spike and channel patterns end in a wedge. The channel oftentimes has 3 pushes. For example, here's a very strong bull spike and a channel, and there are 3 pushes in the channel, and the market broke out of the top of the channel and then formed a 2-bar reversal, and then an IOI pattern, an inside bar, outside bar, inside bar. So that's a reasonably good sell setup. At the bottom we have 3 pushes down, not wedge shaped at all, but functionally it's the same concept as a wedge. So once you start getting a parabolic curve, you have connect these 2 lines, and then you connect these 2 points, you get a steeper trend. That's a climactic move, and I call it a parabolic wedge. Even though it's not a wedge shape, it's a 3-push pattern, and it's becoming parabolic. So it's a climax and can lead to a potential reversal. 1-bar final flag. A reversal bar has a bare body, but it has a close above the midpoint. So it's a reasonable signal bar for a test up to the minimum target of the moving average, and probably at least 10 bars 2 legs up. By the way, we have a bear trend. I did not draw the channel in the trend line. We have a strong breakout above the trend line, and then we have a higher low. So this right here is a higher low major trend reversal. Wedges and triangles are the same thing. It's the same process. It's 3 pushes. Here, horizontal, 3 pushes up, it's a triangle. Here, 3 pushes down, 1, 2, and then 3. Triangle, horizontal. Here, 3 pushes down, 1, 2, 3. Also 3 pushes up. The 3 pushes up can come before the pushes down can come before the pushes up. It doesn't matter. As long as there are 3 pushes, as soon as you see 3 pushes in a trading range, I treat it like a triangle, whether or not it has a triangle shape. For example, leg 2 here fell below leg 1, and this does not have a triangle shape, but functionally it's the same price action as a triangle, and I would treat it as a triangle. Breakout mode, it can break out in either direction. Here, same chart, and there was a triangle here, but here you can draw a 3-push pattern, and it's a wedge lower high major trend reversal. You have a bull trend, a trend line break. I don't have the trend line drawn. A test below the moving average with a lot of selling pressure, and then we pushed up 3 times. We broke above the top of the channel, and then we reversed down in a 2-bar reversal. So traders will short one tick below the low of that bear bar, looking for a lower high major trend reversal. It does not matter that after this first push up, we got a new low. That's very common in wedge patterns. Okay, we have a failed breakout above a double top. So we have a double top here and here. Double tops are rarely exact. And then here we broke above the top of the pattern, and we reversed down in a bear reversal bar. It's a 3-push pattern. Functionally, it's the same as a wedge. I could have drawn a trend line below, and I could have called it a triangle. But again, it's the same process. 3 pushes, a failed breakout, and then a reversal. Here, 3 more pushes. We have a double top and a breakout, and it failed on the next bar. Functionally the same as a wedge. So we have a double top, a bull breakout that failed. It's the same process as a wedge, and it's a reasonable short. Again, failed breakouts of double tops and bottoms. Not a wedge shape, but the same process, and you treat it the same. I talked about this one a moment ago. Here's another one, a double top, a bull breakout, a failed breakout bar, and a trend down. A double bottom, a small double bottom, a strong bear breakout, a 2-bar reversal, or a bull inside bar. You can call it either one. So the third push down here and a reversal up. Wedges are channels. Anything contained within 2 lines is a channel. It doesn't matter if the lines are converging, if they're parallel or diverging. And like all channels, usually the market will evolve into a trading range. And usually the market breaks out in the opposite direction of the channel. So a wedge, if it's an upward wedge, it usually has a bear breakout, and the upward wedge, upward channel, usually functions as a bear flag, even if it's in a bull trend. If you have a downward wedge, it usually behaves like a bull flag and has a bull breakout. About 25% of times, the wedge reversal fails, and the breakout occurs in the wrong direction. So in other words, you can have a bull wedge and then a successful bull breakout leading to a new leg up and an accelerated bull. You can have a bear trend and then a wedge bottom, and instead of breaking to the upside, it can break to the downside and lead to an even stronger bear trend. In general, whenever the market follows the lower probability path, you should expect an accelerated trend, a fast breakout, a measured move, and 2 legs. So a wedge bottom is more likely to break out of the top, right? So it's less likely to break out of the bottom. If you get the successful downside breakout, you should expect 2 legs down and a measured move, and it probably will be pretty fast. It'll be fast because traders were expecting the upside breakout, and everyone's positioned for the upside breakout. So for an example, let's say you have a wedge bottom, and instead of reversing up, it breaks to the downside. You should look to a measured move down based on the height of the wedge, and the move will probably have 2 legs. It might have more, but it usually has at least 2 legs. And why does it move so fast? Because the bulls were buying as the wedge was forming, and if it falls below the wedge, that's their stop. So the bulls will sell out of longs, and the bears will short the breakout, and they'll short any pullback. So the bears are shorting and the bulls are selling, so everybody's selling, and the market will move down pretty quickly. Once the market reaches the measured move down, the bears will buy back their shorts to take profits, and the bulls will begin buying again, looking for a 2-legged move up. So for example, here's a bear trend and a wedge bottom with a decent bull inside bar for the signal bar. It tried to break out of the top, and now we have an IOI pattern, an inside bar, outside bar, inside bar with a bear body. The bulls who are long in here they'll exit below this bottom of the wedge, the bottom of this outside bar. Bears will look at this and say, this should go up. If it goes down, it probably will go down at least 2 legs, and at least for a measured move based on the height of the wedge. Here's the top of the wedge, here's the bottom of the wedge, here's a measured move down. So bears will short exactly where the bulls are exiting. Some bulls will reverse, most don't like to reverse, and they'll simply get out. So the bears will short here. They may short the close of this bar, The follow-through bar has a bear close. They might short that. They might short on a stop below the low of that bar. Here we have a bear microchannel, 6 or 7 bars down without a pullback. They'll sell at the high of this bar, and then we have a bear inside bar. They'll sell below that bar until we get down to the target. And once we get down to the target, the bears will buy back to take profits, and the bulls will buy for a scalp up at least to the moving average, and maybe 10 bars and 2 legs sideways to up. And we have a bull reversal bar here, so it's a reasonable buy. Wedges, what are your profit targets? Again, a wedge is a channel, and a wedge in a channel usually evolves into a trading range. If you have a wedge top, the first target is the bottom of the wedge. If it goes below the bottom of the wedge, the next target is a measured move down based on the height of the wedge. So for example, we have a wedge bottom, and we have an IOI buy with a bull body, so a reasonable buy. You could also extend this line back here and form a larger wedge. But in any case, we have a wedge bottom, a lot of two-sided trading, might be the bottom of a trading range. And then we have an extremely strong bull breakout. First target is the top of the wedge. We did not find profit taking there. We did not find selling there. In fact, we found more buying. So at this point, it's an always in bull trend, very strong. Second target is a measured move up based on the height of the wedge, and it reached that later in the day. Over here, after such a strong breakout above the top of this bear trend, the market formed a higher low major trend reversal. A wedge can be a reversal pattern. So if you have a bear trend and then a bear wedge, it can be the low of the bear and the start of a bull trend. Or it can also be a pullback. So if you have a bull trend and then a wedge pullback, that can be a bull flag. The wedge can be the end of a trend, or it can be the end of a leg in a trading range. So either one, the wedge can act as a reversal pattern. Wedges can be extremely steep, especially on the open, and they often become the channel in a spike and channel pattern. Remember, a gap is a trend bar, effectively a trend bar. It's a spike, a breakout. So we have a gap up for the spike, and then we have a channel with 3 pushes up, and we have a bear signal bar. And since it's occurring in the open, it's probably a reasonable short. I don't have it drawn in, but it looks like it's probably around a measured move up based on the height of this leg down. Wedges are rarely perfect, and I call any 3-push pattern a wedge, even if it does not have a wedge shape. So we have 3 pushes up here, a lot of trading range behavior, a reasonable short. Again, lots of trading range behavior, lots of buying pressure, very two-sided, prominent tails. So probably a wedge bottom in a trading range. The market continued to grow into a trading range. 3 pushes here, new high above the top of the range, and a bear reversal bar. So a reasonable short at the top of a trading range. It's a 2-legged move. We have a strong move up here, and then a pullback, and then a second leg up. Second leg up had 2 legs, and arguably even a wedge shape if you start here at 1, 2, 3. So reasonable short at the top of a trading range. Again, not really a wedge shape, doesn't matter. If it has 3 pushes and the context is right, it should function like a wedge. Okay, instead of a wedge reversal, a wedge can be a pullback within a trend. So for example, a bull flag can have a wedge shape, and a bull flag is a small bear trend. So you have a rally and then a pullback in a wedge shape. That's a small bear trend, and the wedge shape could be the end of that small bear trend, resulting in a rally. A bear flag can have a wedge shape, so you can be selling off and then have a rally that has a wedge shape. Any rally is a small bull trend, and if it has a wedge shape, it could be the end of that bull trend and become a bear flag. So for example, we have a bear trend and we have a wedge rally. So this wedge rally is a wedge pullback, another wedge pullback, another wedge pullback. Every pullback is a small bull trend. So this small bull trend ended in a wedge top. This small bull trend ended in a wedge top. Where are the three pushes? Up here and then down, up here and then down, and then up here. So it's a wedge. This has three pushes up and then down, up and then down, and then up again. Again, a wedge-shaped pullback. You can argue that this is just a two-legged pullback, a high two buy, one push down, two pushes down. But a lot of times there'll be a first push before the final high of the trend. So to me, the first push down began here, and you can call it a high two, but I would call this a wedge bull flag. Here's a wedge that had four pushes down. Each of these bear bars is a push down, so it's still functionally a wedge. If it has four pushes, it has three. You have a double bottom and a bear breakout, so three pushes down. One, and then the double bottom is two, and the breakout is three. The failed breakout is functionally the same as a wedge bottom. And that's the end of the module on wedges.